Welcome to the REI Diamonds Show with Dan Breslin, your source for real estate investment jewels of wisdom.
Welcome to the REI Diamond Show. I'm your host, Dan Breslin, and this is episode 162 on investing in your life, not just your portfolio, with David Blain. If you're into real estate investing and building wealth, you are in the right place. My role here on the REI Diamond Show is to invite guests who specialize in building wealth, such as real estate investors and other industry service providers, and draw out the jewels of wisdom, the tactics, mindsets, and methods used to create millions of dollars and more in the business of real estate. So today's guest, David Blain, joins us to discuss investing in your life, not just your portfolio, which also happens to be the title of David's book on investing your money. David and I discuss investing today in a method to widen the scope past just real estate investing and to view the entire picture of your net worth. David is a chartered financial analyst, finance expert, and wealth advisor with a history in flipping houses. So he's just the type of guy that understands the plight of us real estate investors. So without further ado, here is David Blain. Yeah, Mr. David Blain, welcome to the REI Diamond Show. How you doing today?
I'm doing great, Dan. Thanks for having me on today.
For sure. I really appreciate you taking the time out, blocking, I'm sure, your busy schedule to give us some of the wisdom that you've gained over the years and join us here on the REI Diamond Show for the next hour or so. So I appreciate that. So, David, whereabouts in the U.S. are you recording from? The listeners assume and know I'm from Chicago here, but to give people a little context of who you are.
Yeah, I am currently sitting in beautiful eastern North Carolina, the town of New Bern, which is way over on the coast. That I ended up here. I spent some time in the military and I got out and headed east till I hit the water and dropped the flag here about 17 years ago, and we just love it here in eastern North Carolina.
Nice, military man. What branch was it in the service there?
I was in the Army. I spent most of my career at Fort Bragg doing a lot of crazy stuff, a different life than I have now. But yeah, I was in the Army in the 82nd Airborne, and then I was in the Ranger Battalion for a while, and then came back to North Carolina and spent the rest of my career in the Special Operations world.
Wow. Thank you for your service.
Yeah, thank you. Thank you. I appreciate it.
All right, so we have a little bit of a military history background. So what else for the listeners, David? Let's do the origination story here. I know from inside information that you were a real estate guy at first, and for the listeners, we're going to get to the wealth advisory section of your life, but do you kind of want to fill in some of the details and the blanks there to help people know who you are?
Yeah, I'd be happy to, Dan. So I did. I went to West Point and studied there, got a degree, but always had an interest in investing. And so when I was in the military, I started investing in your regular investments, stocks and things like that. And I just picked up a love of real estate. And I heard someone, I was thinking about it the other day, and I can't even remember who it was, but somebody that I talked to, old wise colonel or something, and he said, David, actually it would have been Lieutenant Blain, when you move around all these places, he said, if you can, go ahead and buy a place wherever you go and just keep it. And when you leave, rent it out. That military bases are usually pretty good places to own rental properties. And when I was a kid, my dad had a townhouse rental, so I kind of had a concept of the idea. So I jumped right in and I started doing that, started buying houses where I was stationed, and then when I would move, I would go ahead and keep them as rentals. And then as I started, I was actually fractured 3 vertebrae in my neck, and so I had to come off of like the operational team for what I did, and I started looking around for something to do, what I wanted to do, and I started buying these houses outside of Fort Bragg and Fayetteville, and this was in the mid 90s, and I saw, a lot of the lower paid soldiers would live in mobile home parks, and there's nothing wrong with that. In fact, they can be great investments. But I sort of had this dream, some of my soldiers, wanted to get out of that and into a regular house. And so I started buying these bank foreclosures, fixing them up and selling them for no money down to soldiers. And that's kind of where it started. I had an arrangement with a bank, that if I didn't pay more than tax value, they would fund the deal within 3 days. And so I kind of became known around town as somebody that could actually close these deals. At the time, there's a lot of people running around trying to do these no money down, like sell it before you actually owned it type thing, which is nothing wrong with that. But I actually had money. And so a lot of the banks were willing to give me their foreclosures because they knew that I was going to close. And I had sort of a system down where I would, they were all the same. They were like these 70s brick ranches. And so we would fix them up. And at the time, this was, you could do this, but we would actually loan people the down payment. So they would go get an 80% mortgage, and we would loan them the 20%. And we'd take that note and we'd say, hey, look, don't worry about it. You don't have to pay us back. And we'd throw it in the drawer. And when the house closed, when they sold someday, magically at closing, we would show up with our second mortgage and get paid out that way. So that's kind of how it started, my love of investing in real estate.
Nice. So what was the shift? I mean, I'm a real estate guy. Most of our listeners are real estate guys and gals out there. And we're probably, bleeding heart real estate investors, right? I'm like dead set on collecting rentals, not necessarily me now at this point, because my business is growing, but the average person who gets into real estate is dead set on, never investing in a stock again for a lot of them. I mean, and I would imagine that you had I'm going out on a limb here, but maybe you had a similar exclusive passion for real estate while you're doing it and it was working so well. But then what happened to cause the transition for you, David?
Yeah, I mean, I did. I always wanted to, so as I was making money, and I pursued a multiple strategy. If you recall, the mid 90s was a great time to be a stock investor. And, I owned all that, Cisco and Microsoft, Home Depot, some of those original tech bubble stocks, and did very well. So I was really pursuing a multiple strategy. And as I started creating some income and some wealth, I had a hard time finding people that I could trust to help me. So I started learning, tax and investing, and it was not, and so I decided to set up a firm that could serve people the way I wanted to in the regular areas, not just real estate investing, but in tax and keeping people out of, keeping them away from insurance salesmen. When I was in the military, there were these insurance companies that sort of preyed on people and tried to sell them insurance policies they didn't need it. So really, Dan, I mean, real estate was something I loved, but I always had in mind that I wanted to do this. And frankly, the real estate in those early years, it allowed me to build my company, honestly. It provided the income that I needed to build my company. And like you and a lot of people, I accumulated a number of individual rental properties, branched out in some commercial stuff. And it was interesting. I was listening to one of your podcasts from a couple of weeks ago, Travis Watts, who was on. And really, I had to make a decision in terms of where I went, and my company, Blue Sky, really started taking off. And so for me, it was really a function of the time commitment of investing in real estate as a business. And maybe we'll get into this later, but that's one of the things that I really encourage people to determine is, are they investing in real estate or are they in the business of real estate? And those two things will really determine what you do. And in my particular case, I decided that I wanted to invest in real estate, but I wanted my business to be more of a comprehensive, total, wealth type of a firm.
Would you mind kind of defining each of those circumstances? We have real estate as an investment and we have real estate as a business. I've touched on this on some previous shows, but I'd be curious how you articulate that.
Yeah, sure. And I think it's one thing, especially with the clients that I deal with, is figuring out, is this your business? Is this what you want to do as your primary source of income? And is it something that you want to devote time to? So those are the two factors for me. Is it one of your primary sources of income, or would you like it to be? And number two, is it something that you're going to devote, time and effort to? Are you planning to build the infrastructure around a business where you have other people and you have your own real estate, you have an office maybe for your real estate company, and that you're trying to build a sustainable, ongoing business that is not just making money from, rent and things like that, but you're making money from being in the business of real estate. So that's one thing. And on the investor side, I tend to equate the investor in real estate as more of a passive type investment. I mean, it doesn't have to be completely and totally passive, but it certainly strays on the passive side of things. And I think it's really important to make that determination, because where you put your time and effort and your capital and things like that, and when people confuse them, when they're trying to be a real estate investor, but then they try to turn it into a business, it turns out very poorly. Or if they're actually in business real estate, but they're treating it like just investing, that also is not going to work out well. But I kind of make the definition between what percentage of your income is it and how active are you in it, as well as what's the future look like. If you're just trying to own some houses or some buildings and collect the rents, that's great. That's more on the passive side. If you're going to get into managing those properties, hiring other people, of course, is a big dividing line between an investor and someone that's in the business of real estate. Typically, as an investor, as a passive investor, you're not going to have employees that are running these properties for you.
Yeah, I think of my own example, my own story, David. So when I got into real estate business back in 2006, I flunked out of car sales and, working at warehouses. A bunch of jobs didn't work, didn't finish college at Villanova myself. So a lot of stuff wasn't working for me. And I remember going to the Get Rich in Real Estate seminars that are still prevalent, and there was a lot of great information there, and it did change my life looking back, although it was an expensive education there. But I remember, they were teaching kind of a combination of this. Oh, it's real estate as a business, you're flipping houses, and it's real estate as an investment. Buying rental property is the way to financial freedom, similar to what you just described, David, where that was what allowed you to leverage to the next step of creating Blue Sky, the wealth advisory firm that you run now. But I think to myself, it was like I was confused, and I didn't really have anybody saying, oh, no, you have to, Dan Breslin, you have to create a real estate business first so that your tax returns show decent income, and you have maybe that income to cover some losses that might come along the way and turnovers and things of that nature. So I spread my energy too thin trying to be a real estate investor before I even had the capital to do so. And at the same time, not recognizing that I should have put all of that attention into, I needed to build that source of income first, which brings me to where I'm at today. And I have, a handful of rentals in the different cities where we operate our business, Diamond Equity Investments. And I have my portfolio, and I don't know if her name was Mary, but I read in your book that there was a client whose tax returns you looked over, and she was in another type of business, not real estate. She was making decent money, and when you reevaluated her tax returns, you saw that she was losing money, and this was probably in the early 2000s. And it seemed like she had to kind of reorganize things. I look at my own tax returns are probably showing losses for my portfolio, and I'm like, man, it's maybe time for me to take that same line of thinking. I'm dedicating more of my energy and focus into creating the business right now, because that's where I'm getting the return on investment. But that's probably an experience that you've seen a lot of people kind of make that mistake and not necessarily delineate the right way. Is this an investment? Is this a business?
That's right. And in that particular person's case, yeah, she was investing in this real estate, but also had private company stock that she got cashed out in. And so we sold every one of those properties in that year, and all those accumulated passive losses we used against that gain on the sale of the stock. But yeah, it's really important to figure out where you focus. And of course, from the tax standpoint too, I don't want to, turn this into a tax call, but there's a big difference between fix and flip generating ordinary income and a long-term hold where you're, free of Social Security, Medicare tax on that rental income, but at the same time, you're not eligible for a lot of things like if the health insurance deduction is important, or if you're trying to fund a 401k, or some of the things where you do need earned income, and you kind of have to look at the math and the after-tax benefits or objectives to figure out how you want to structure that business. And if you want to kind of drift towards, hey, I want to be in a business, or I just want to keep it passive and own some properties and let the income flow through to me. And, today I've it was funny listening to Travis, because the same thing, I've sold all my individual properties except for our own office buildings that the company is in, and do all my investing in real estate now through other syndicated deals, some people that I've met through the years that are really good operators that I trust with my capital. And so, I would say years ago, I was in the business of real estate. I've actually developed a 500-acre development that I bought and developed houses and all that, and owned multifamily, single family, land, everything in between. But now I consider myself a passive investor.
So we have two places I want to go in the conversation here. One, our nameless client who had to take these losses that year to offset her income in that other place. There was another spot in your book, and I think it was a similar husband-wife client, and they had put their money with a lawyer who is investing in single selected stocks, and it did not go as they intended. And this was probably as the economy was bouncing back, I believe, after the 2010 era, if I had to guess, or I'm remembering correctly.
Yes.
And I assume they had to lose some money when they came to you and got out of that stuff. We had to lock in the losses when the portfolio went down. And would you mind touching on, maybe if you could, psychology of, hey, sometimes you have to take the loss to get out from under that, right? Because I know for me, I don't want to lose money. And so I'm hanging on to some probably loser stocks in one of my portfolios that, it might be better off rebalancing, but I feel like maybe this is a weak spot for me and maybe others where hey, cutting losses might be difficult, but there's a time and a place for that. Do you have any experience with that, David?
Oh, sure. The way I look at it is, especially if you have individual stocks and or even houses, but look at it today and, hey, would I buy this house today? Would I buy this stock today? But no, we don't like holding on to things. There's a number of what we call psychological behavioral finance issues going on there. One of them, it's called anchoring, where you sort of anchor on, hey, I paid $50 for this stock. I can't wait for it to once I get back to 50. And what you have to understand is just kind of look at, okay, what is going to make your capital going forward the best? And of course, the tax code affords, you can take up to $3,000 of capital loss against ordinary income. And then you can also bank those losses, which becomes really handy, especially if you're a real estate investor and you can bank those losses. So we typically are going to tell people, hey, if you wouldn't buy it today, let's go ahead and sell it. The other thing is it can keep going down as well. Some of the famous cases of, the Enron of years ago and things like that, where people kept hitting these plateaus and said, well, it can't go any lower. So no, I'm pretty, most of our investing here at Blue Sky is more of a broad-based. We don't do pick individual stocks anymore, but certainly in the individual stock arena, I'm fast on the mouse to get rid of them if they're at a loss. Yeah.
What was that, if you remembered back, was there ever a time that you came to grips and that was like a light bulb and it was like, oh, wait a minute, I got to take the loss? Or was that something that, I don't know, maybe the military training prepared you for this and it was just psychologically not as much of an issue for you as it maybe is for me right now, let's say?
Yeah, for me, it's just looking at, okay, how am I going to get back to even fastest? And if the company or the investment that I have is not the vehicle, well, let's go ahead and put that capital to work somewhere else. It's a sunk cost. If you bought something, for $100 a share and it's $75 a share, the stock doesn't care what you paid for it. The question is, what's going to get you back to 100 faster? Is it what you currently own, or is it something else? Oh, and by the way, Uncle Sam and possibly your state is going to help subsidize that loss while you're waiting for it to get back to even. So I look at it from those two perspectives. What's going to get me back the quickest? And then number two is the tax benefits, especially if you have another person I can think of. It wasn't real estate, but it was stock that came to me in the fall of 2008. And I looked at him and I said, here's what we're going to do. I said, we're going to sell every single thing you own. Actually, we just did this in March. When the market tanked, we went through every portfolio, any security that was a loss, we sold. Now, we immediately rebuy something, so it's not like we're timing the market, but to take those losses and set them to the side, let Uncle Sam and your state subsidize your loss on your taxes, we think is almost there's almost no way to lose out on that strategy.
So you take the loss, then rebalance in the stock world.
Yeah. Take the loss, rebuy something. We're not a market timer, so you would sell it and then immediately buy another security. It can't be the exact same one, but there's plenty of choices out there. It's easy to do. And then you get to set that loss aside on your taxes to either offset future gains, or if you had a property or another stock that you had a gain, it can immediately wipe it out.
Yeah, I think we have right now in our company across our 3 regions, I think we have like 108 deals in our inventory. And a chunk of those are going to lose money. Like, we don't even have buyers for them yet. And so every price drop is like another, larger loss. But at the same time, something like this would drive me nuts before. End of the world, losing sleep, mad at the deal, mad at the partner I did the deal with, mad at the person that sold me the deal. In my head, not yelling at everybody. But now it's definitely more, I think, calm and strategic. In my mind, the way that you just described it, like, we have to get out of those properties. We have to free the capital up. We have to free the energy up. And like with the piece of real estate that we're doing a fix and flip on, is what you know as well as I do, David, like, if we don't sell it, there's still carrying costs. It's sitting empty, not earning any rent. If we did rent the thing out, we can't sell it as a renovated property. If we did revisit that in a year or two, and we're probably not going to cash flow on it with a lot of the properties that we're in. Not that I'm losing money on all 108, but there's certainly 2 or 3 that pop to mind that I am pulling out of. But that's a different topic for another podcast, or we'll just sweep that topic under the rug for now. So the question I want to ask next, David, is, would you mind if there are such a thing, maybe like different categories or classes of investors? Maybe it's defined by age or years in the career or investable assets. Like, what are the categories that investors are at? So like, if you're at the beginning of your career, maybe you don't have a lot, maybe it doesn't make sense to get a wealth advisor, or maybe it does. So you can kind of help clarify for me and the listeners, like, when is the right time to engage someone like you? And like, what are those like levels, if you will, of investing?
Yeah, that's a good question. We look at it in terms of complexity. So typically when someone is starting out and they don't have a lot of money, there's not a lot of complexity. There's not a lot of major mistakes that they can make, and there's not a lot of, reward. So just starting out, typically, in fact, my book, I actually wrote, if you don't mind, I plug my book called Invest in Your Life, Not Just Your Portfolio. I actually wrote it as, it's a pretty good little story, but it also has chapters on each topic. And I wrote it for people that don't really need a wealth advisor, that if they just follow some basic advice, and that's been my mantra my whole career, is for most people, if they would just follow the basics, it's actually not that hard to be financially successful in America. If they stay away, if they follow a few basic pieces of advice, spend less than you make, save some money. I mean, you've heard all this before. Save some money. Don't go into too much debt. Don't over leverage yourself. So for most people, that is going to be fine, and they don't need to get overly fancy. Our investing strategy, we believe in owning the market. Some low cost investments from Schwab or Vanguard or something like that is going to serve you well. As you start getting on the investment side, into hundreds of thousands of dollars, maybe it gets a little bit more complicated. As you start adding, of course, real estate into the mix, it becomes more complicated. If your taxes, if you're in some of the higher tax brackets, the rules change. The rules completely change. As you start to have children and trying to figure out how to incorporate your children into, how do you leave your money? How do you structure your money? Certainly if you have companies, LLCs and an operating company, if you're a business owner, those are the complexities that we think necessitate some professional advice. But as far as, pure, if it's just, stock type investing, somewhere around $500,000 or more is probably a good time to start thinking about making sure that you know what you're doing.
That you know what you're doing, or you're finding someone like yourself, you mean?
Right, exactly. And, I think of it myself, for the pure investing, and it didn't used to be this way, but today, the pure investing standpoint, there's no reason that someone of modest to middle class means can't, they don't need to spend a small fortune. We happen to be what's called a flat fee advisor. We charge a flat fee for our advice. Some places charge a percentage of the money that they manage, which we think is a misalignment of conflict of interest, of misalignment of interest between the investor. For example, you come into, a place and you have $500,000. The guy that charged a percentage of your assets, well, he's not going to say go buy a rental property with that money because you're going to cut his fee. But there are some more and more flat fee advisors out there. There are advisors that would charge hourly. So if you're beginning your net worth, you could just go in for a checkup with one of these hourly advisors and say, hey, what do you think? This is what I've done with my portfolio, or this is the rental property that I purchased. And, for a couple $100 or $1,000 or two, you can get a pretty good overview of your situation and how you're doing. As you start to get into more complexity, things like that, then I do think it's appropriate, and of course I'm biased, to find a flat fee-only advisor that doesn't sell any type of products, and their only income comes from you as the client, and it's based on the complexity of the situation.
So in a sense, if I'm going to make the analogy right, utilizing a fee-only, a flat fee advisor would be maybe similar to like hiring an attorney, or I guess paying the doctor, as opposed to like going to, an automobile dealership where they're trying to sell you Chevrolets and they're biased toward the Chevrolet. And it seems like there's two kind of thought philosophies out there. In your world, there's that broker who's earning those commissions on selling you whatever has the highest commission. And then there's people who say, hey, this is my fee. You got to pay the fee, but I'm going to give you, the unbiased advice and direction there according to your situation, right?
That's exactly right. And there's no system that's perfect, but we feel like a flat fee, so the person has the freedom to say, hey, look, Dan, you're doing a great job. Don't change anything. And you might need to hear that. That might be the right answer. Or, hey, just tweak this. So if you're paying someone by an action that you have to take, either to buy a product or invest in a certain account or to take some action, you don't want that type of advisor. And even the hourly, you have to be somewhat cautious of. I know, attorneys are sort of famous for this, but you do have to be careful about paying by the hour, because if you're not the expert, it's really hard to tell if that's an appropriate amount of time being spent on it. So once again, it's not perfect, but we feel like the flat fee is the way to go if you're looking for a financial advisor.
Yeah, the hourly can tend to be all of a sudden their interests are aligned with the clock instead of the client, whereas the flat fee maybe not as much.
Right. That's our feeling. And especially, a lot of people listening to this are real estate investors, and your flat fee advisors, a lot of them are going to have a much greater breadth of knowledge and service, and are going to be able to help maybe with some advice on that, as opposed to someone that's more on the pure investment or charge a percentage of assets. Those fall more into the investment advisor type, and they're not going to be able to really help a whole lot with anything with real estate. They don't know what to do with it, and how it fits in your overall portfolio. And I tell people all the time, not just because I love all of our clients invest in real estate, at a minimum through the public markets, but a lot of them we actually help them find and select syndicated deals, or if they do have an interest in it, we'll help them acquire or manage individual properties. If they're more on the business end of things, and being able to do that for a flat fee, where the investment focused type places, they don't know what to do with real estate or how it fits in someone's overall strategy.
Is there, a certain percentage of the portfolio that should be allocated to real estate? Do you have some kind of weighting rule of thumb that you go by?
I do. So, ever since the ancient times, if you go back to some of the ancient Jewish writings, they said put a third of your land in property, a third in gold, and a third in, corn or wheat or something. I can't remember. I'm not Jewish, but I'm familiar. It was, a third, a third, a third. And so we think that's a pretty good starting point to kind of think about. Now, we get a little bit more sophisticated, but I don't really get nervous until so if someone as an investor has a third of their money, that's fine. Anything over a half, I want that person to be in the business of real estate, or used to be in real estate, or something. They have to have some comfort level to it. But we get a little bit more sophisticated, and we look at, for example, the net worth of someone, and then their time horizon, obviously for needing the money. Now, if they're investing for cash flow, that's a little bit different. But if they're investing to make money in the hopes of selling or something like that, we certainly look at the time horizon. But generally, for people in the, sub $1 million, maybe a couple $1 million, we're looking at, somewhere 10-15% of their money in real estate. As you bump up, greater than a couple $1 million, we're going to want to take that number, at least 20-25%, and then, like I said, on up to a third. And if they're have some degree of sophistication in real estate, or it's more of their business or something like that, we'll go up to half. Some people certainly have more than half in real estate, and that's okay. But for someone that doesn't already have it, we prefer to develop other streams of income. So obviously a regular portfolio of stocks, bonds, that kind of stuff. And then the third thing we actually teach, Dan, is if you can, now not everybody can do it, but ownership in some type of operating business. So income producing real estate, some amount of money in stocks, bonds, cash, liquid, what I call paper assets, where you get like a statement, that paper asset. And then the other thing that we encourage people to try to develop is a stream of income from some sort of functioning business, whether they're a partner or it's a company they used to own and now they're just a passive owner, but some type of ownership that they can benefit from that type of income stream. And the proportion between those three is really going to vary based on the person's net worth, their time horizon, and their interest or sophistication.
So the real estate makes sense. I know where to find real estate deals. Most people do too. The bonds and stocks, that kind of makes sense. We go, sit with you and we put them into the Vanguard fund or one of the others, or, however that goes. We know where to buy that. But where would you suggest clients are finding the 1/3 in the operating business? And maybe you have specific examples without sharing names of types of businesses that clients might have entered at your suggestion in this manner?
Yeah, that's probably the most difficult one to do. A lot of our clients are business owners, and so we sort of manage that piece of their net worth. And the way we do that is instead of selling their company, we'll have them retain a small percentage of it. We also look for opportunities in other family members. If they're in an industry, like if we have a lot of clients that work in high tech, and so looking for opportunities to put some money to work in, maybe they have a vendor or something that's raising capital. What we tend not to do is, it used to be a little bit easier, but the private equity world today of sort of Wall Street and the firms that specialize in this, a lot of the returns have really come down in that area. And so we don't recommend a lot of private equity funds. The ones that are still making decent returns, like none of us have enough money to get in those. Maybe somebody on your podcast does, but for most of us, we don't have enough money to get into those. And so you're left with sort of these middle tier private equity funds. But that is a possibility for accredited investors. There still are some opportunities in there, but that is arguably the toughest one to be able to accomplish, is to get money in that. But what it does, it gets you some diversification. It gets you actively involved in other parts of the economy that you don't have like a market quote daily for the price of the investment.
Can help you sleep at night. You touched a bit on the accredited investor. So let's assume you have a client that is accredited investor, and you also touched on investing passively through some syndications personally a little earlier in the episode. And I'm curious, do you actually have, or have you kind of steered and recommended some of the clients to some of those syndications as well, or do you kind of steer them to like private equity, middle tier, and these other places to kind of fill in? I don't know. These are alternative investments that are passive, right?
Yeah, well, on the real estate side, we do actively vet and recommend syndication partners. In fact, we have a couple firms that we work with regularly. We know the owners of the firm. I live in a small place in Eastern North Carolina. I'm not real big on the whole Wall Street type of thing. So we found some really good firms that source really good deals in second tier, like Class B properties in second tier cities. We found are really good money makers in real estate, and so we actively work in those arenas. We don't, like I said, the private equity world has kind of the returns have really come down. There's a lot of entrants in that market, and so we don't currently recommend any specific deals in that. Well, we tell people to keep their eyes open, and we would also say some of the more active real estate deals. Like I just had somebody the other day who sent me information on a redevelopment project in Atlanta, in fact. And that, while it is real estate, that to me falls more in the private business end of things. It is real estate, but the business model is going to make its money on the business execution of the business strategy, as opposed to the natural cash flow and natural appreciation of the real estate. And so that's kind of a distinction that I look at, is what's driving the return? Is the return being driven by the normal cash flows of a rental property and the normal appreciation of real estate? Or is it being driven by the operator's intellectual capital or effort or something? And that, so you can have that private business metric being met even if it is in its product happens to be real estate, if that makes sense.
So on the redevelopment deal, and almost you could categorize any real estate development, they are much higher risk because of the timeline, at least from my perspective. I'm not good at them, good at selecting them. I couldn't tell you a good developer from one that's not as good as the good one, but would the that more of a business model, you're saying that redevelopment deal, you would categorize that as the third in the business, correct?
Exactly. I would not really call that part of your real estate strategy, because the return driver is from the value add or the redevelopment or whatever. It's not from purely the real estate itself. So so I would put that in the business bucket.
That makes sense. Yeah, there's a lot more that can go awry during a development versus an occupied, stable, turnkey investment where rents are being raised as the value add, as opposed to a fully vacant 197-unit apartment complex with supply chain issues created by COVID recently, trade wars. The list goes on and on of things that could go wrong with a deal that's under construction versus 197 families or occupants that are already paying rent, or maybe there's 10 or 15 that are not, but that's a different kind of a problem to solve in a much more stable operating real estate investment.
Right, and that's a good point, Dan. So in our world, real estate investing means cash flow. Like, these are occupied people. There's actually tenants in there that are paying rent each and every month. That's right. That is, and I think it's important. There's all sorts of ways to invest in real estate, but for us, it's a cash flow. It's a cash flow deal. If it's not cash flow positive, if it's not then it falls over in the business side of things, where there's a lot more variables and a lot more external factors, as well as a lot more control, or the ability of the people running it have a lot more impact on the outcome. I mean, let's face it, if you have a good, multifamily, a good apartment complex with a decent manager, and you're somewhat competent, you should be able to make money, as opposed to a real estate development. Unless you really know what you're doing, not only are you not going to make money, you're going to lose a whole bunch of money.
Yeah, you're right about that, David. So for, people in your life, what will be the 2 or 3 book recommendations that you make most often, David?
One of my favorite books is Getting Things Done by David Allen. I have a lot of stuff going on and that I do in my life in addition to my company, and people always say, gosh, how do you get so much done? And that book really helped me early on and helped define how I spend my time and really to get, like it says, get stuff done. So that's one that I always encourage people to read if they don't have a system for getting through the day and the things that they want to do. I like that one. For a while, I was a big, Stephen Covey kind of guy, but I just couldn't, having to relate, okay, I'm writing this memo. How does that relate to my life goal? I can't function that way. So I like getting things done because it like really zeroes down like how can I accomplish stuff and what should I not do and things like that. So that's number one. Number two, there's a book by Angela Duckworth called Grit. Grit is an amazing book, and the reason I first picked it up, I guess a little self-serving, is she studied West Point cadets, and she wanted to find out what makes them successful. And because over the years, like they spend a lot of money, investing in these young people, and so when someone doesn't make it through West Point, it's a really poor result. And so they've done these studies, and what she found is it's not the smartest people, it's not the most athletic, it's not the people with the most leadership, it's the people that never give up, the people that have at least a portion of those attributes enough to get by, but they just won't give up. And Grit is a really amazing book to read about what really it takes to be successful in all areas. She talks about athletes, military, business people, all sorts of walks of life. And she studied this, and it really helped zero in on, when you're trying to be successful as a business owner, real estate investor, whatever you're trying to do, what are those sort of levers that you can pull to be successful that really, really matter? So that's one. And then the third one that I like, it's a classic, and I know there are updated books. It's getting a little bit old, but the classic Dale Carnegie, How to Win Friends and Influence People, is just a great book for people. I teach my own kids this. I say if there's two things you learn, is one is how to communicate with people, and number two is how to negotiate. Your whole life, if you can learn to do those two things very well, you will be successful beyond most people if you can communicate and negotiate. And I think the Dale Carnegie book really sets a good foundation for advanced exploration of that topic of how to deal with people.
Three great recommendations there. David, if you could go back and share the crown jewel of wisdom with yourself, getting out of West Point, right at the end of West Point, what would that be?
I was joking. Somebody asked me what it was, and it would be don't buy a $300 car that you have to shovel the mulch out of the trunk. Like that was my first car. So I was joking. Don't do that. It's a waste of money. But no, I think when I was younger, I did. I was always very industrious and worked very hard and had jobs and did things. But man, life goes by very quickly. And if I, as I tell my own teenagers, start early in this stuff, get some education, invest in yourself, not just, college, not just like book knowledge, but invest in yourself in terms of knowledge of finance and real estate and how money works. I just feel like as a society, we're somewhat ignorant of money, and to have the confidence. A lot of our problems are caused by money, divorce and stress and things like that. And I just think if I could tell young people is get a foundation, and no one's going to teach it to you. You're not going to get it in a finance class or accounting class. This is going out and doing research and studying on your own, and get a good foundation of finance, because whether you think money is important or not, and, the root of all evil, all these type of things, the reality is when you go to the grocery store, they would like money when you go to checkout. And if you don't acknowledge that and have a good foundation, you're going to be one step behind your entire life. And so that's kind of what, I guess, why I'm in the business I'm in is trying to get people out of these, to think about money in a different way. And like the title of my book says, invest in your life. It's not about your portfolio. It's about achieving things that you want in life. And you can only do that when you're in control and you're the master of the dollar.
It's funny that you say all that because I get to hear a lot of very successful people like yourself come on my show here, David, and it's a treat. But I get to see various starting points for people, and like a lot of the people who come on the show, they did start young. They were 19 buying a duplex. They're 21 and they've got 3 or 4 rental properties, and fast forward 15, 20, 25 years later, and they're on the show and they have this exemplary story there. And I look at my own lack of understanding of money growing up, to 26, having not had the grit and determination to finish a whole bunch of things. I had great parents and a great upbringing, and I finished college and I did things right and did a lot of things wrong. But man, that hole in my knowledge, like you said, it's almost a societal thing across the board. And in the last 15 years since I've gotten in the real estate business, a lot of the work that I've personally done on myself has been psychology around money, learning how money works, learning things like, the tax strategies that we touched on lightly here today. And the list would go on and on and on about the things that I've had to personally work on to make the progress that I've been blessed to have to this point. So underline, underscore, and an exclamation point on your crown jewel of wisdom there, David. So how can listeners get more David Blain? You want to mention the book and maybe where they could go to get a taste of that?
Yeah. So obviously the book, Invest in Your Life, Not Just Your Portfolio. Like I said, it's a good resource, as well as it's a good read, people say. We've actually set up a special website for a landing page. If you go to our company website, which is blueskywa.com, that's blue sky and then the letters wa.com/real estate. You can go there and we'll give you a free chapter of the book, or if you just want the whole book, of course, you can go to Amazon, Invest in Your Life, Not Just Your Portfolio. So blueskywa.com is, in fact, the wealth advisory firm if you want more information on me and the firm. We've got a really amazing team of people here as well. You can go there. And then I have also my own website, which is davidblain.com, DAVIDBLAIN.com, that I do have a lot of facets to my life and enjoy some of the charitable things we do, some of the educational things and things like that. So if you want to learn more about me, you can go there as well.
Yeah, and I'll also underline the book recommendation there, David. The topics, the story, a little bit of the conversational tone, so it's like easy to read and digest. But the variety of topics that are brought together in the book, they're normally the kind of things you have to go into 6, 7, 8 different books, locations, and authors to kind of pull together yourself. So you've done a good job synthesizing those topics, and you mentioned it earlier in our episode here that the book itself was great for people, especially if it was, earlier on in the investing career for that person. And that's exactly the truth and how it's laid out and structured. So I just kind of wanted to put that little bow on there before we wrap it up.
Yeah. All right. Thanks, Dan. Yeah, definitely.
Cool. So we are at the top of our time together. Again, David, thank you for blocking out the distractions and giving us so generously of your wisdom and time. I appreciate you coming on the show.
Yeah, no, it's been great, Dan. I really enjoyed it, and it's an honor to be on the show, and just being a real estate guy at heart, to be able to give a few tips to some real estate investors out there. It's been my pleasure.
And thank you for tuning in to this episode of the REI Diamond Show. Here's a pro tip. You can receive early new episode notifications by subscribing through your podcasting app or YouTube. Or you can sign up for email notifications of new episodes at reidiamonds.com. At that site, you can browse the entire 162 episode archive of the REI Diamond Show. There you'll find the episodes are organized in a much easier to read menu format with the ability to sort by topic, which is much easier than scrolling through the podcast or YouTube app, especially if you are in search of specific topics. We discuss everything from single family flipping here on the show, to large multifamily, to syndication, to raising private money, to legal issues, to property management. The list goes on, and I'm sure you get the picture. So that site again is reidiamonds.com. My main business, Diamond Equity Investments, is focused on buying and selling houses. 223 in 2019, 127 houses sold so far in 2020. We currently have another 110 houses in our inventory, either under construction for sale or sold and awaiting closing. So there are 4 ways you and I can do business. Number 1, if you buy houses, like to fix and flip, in Atlanta, Chicago, or the Philadelphia region, I offer my inventory for sale as is prior to beginning to flip. If any other investors want to step in and take me out of the deal, at dealswithroi.com. So you can go to dealswithroi.com and sign up for the correct buyers list. There are 5 in total. They're separated by region, so be sure that you are on your desired city's page when you sign up so that you receive emails of deals in your city. The cities again, Atlanta, Chicago, and Philadelphia. The region, about a 2-hour drive around the downtown of each. So number 2, if you are an accredited investor and you would like to fund one of or many of my deals, you can go to fundrehabdeals.com and sign up to receive private mortgage investment opportunity emails on deals that I do. And number 3, if you have a deal for sale either in Atlanta, Chicago, or the Philadelphia region, please send me an email with the details. And number 4, I am currently seeking a few A players, either located or willing to relocate to the Atlanta, Georgia market, the Jacksonville, Florida market, or the Philadelphia, PA market. This role is a $100,000 to $250,000 a year or more opportunity for the right individual. Full details, including specific instructions on how to raise your hand for this opportunity, are posted under the careers link at www.dealswithroi.com. Since this episode may be heard months or years after I've recorded it, I suggest checking that link for details, as we are growing in several markets around the U.S. and expect to add additional team members consistently going forward. So that concludes this episode of the REI Diamond Show. Next up, I've invited international banker and high-volume financier Anton Matley to join us on the show to discuss the current availability or lack of financing for $1 million and up multifamily apartment deals. I've invited Anton specifically to find out whether banks have completely frozen lending on the larger assets. You already know that I'm a house flipper, like a single family house flipper, and you also probably already know that the real estate market for single family houses is actually red hot right now. But how are things looking for multifamily? We shall dig in next time we meet. Until then, my friend, Danny B here. See ya.
Thank you for listening to this episode of the REI Diamonds Show with Dan Breslin. To receive email notifications of new weekly episodes, sign up at www.reidiamonds.com.